This is a learning and exam preparation video for the IB Business syllabus. At the end of the video are practice assignments for you to prepare you from the exams. Please click www.intmace.com on the link at the bottom of this video to do the assignments for this topic. Unit 1.6, Growth and Evolution 1. Economies of scale, large versus small businesses, growth and evolution. Economies and diseconomies of scale. Scale of operation refers to the size or volume of output. Economies of scale, when a business increases its scale of operation and the process become more efficient, the business has achieved economies of scale. Average unit cost decreases as business increases its size. Diseconomies of scale, when business experiences inefficiencies as it becomes larger, business has achieved diseconomies of scale. Increase in average unit cost as the business increases. 1. Efficiency is measured in terms of cost of production per unit, which are total cost equal fixed cost, FC, plus variable cost, VC, where FC remain constant as production increase while VC changes with change in production. 2. Total cost is used to calculate average cost. Average cost equal to total cost divide quantity produced. It helps to explain the concepts of economies and diseconomies of scale. As per the picture attached, you can see that when a business grows, average costs go down. The business becomes more efficient. After the point of lowest average costs, the business is at optimum production. The point of optimum production is the maximum capacity of business. After it, if business expands, average costs start to rise where business will achieve diseconomies of scale. Efficiency is not only related to production, rather it also attains through lower the average unit costs. Table 1.6.1 shows the internal economies of scale, efficiencies that the business itself can make. 1. Technical. Being units of production can reduce costs because of the law of variable proportions. The increase in variable costs spread against a set of fixed cost. For examples, operating a container ship with one crew, fuel bill, and berthing fee is cheaper than running two or more smaller vessels. Similarly, the A380 passenger airline will be cheaper to operate than two traditional long-haul aircrafts. An articulated lorry will be cheaper to operate than two or three smaller vehicles. 2. Managerial. A bigger business can afford to have managers specializing in one job as opposed to trying to do everything. For example, managers specializing by function, such as production, marketing, finance, and HR, as opposed to having a general manager, can typically work with greater efficiency. 3. Financial. Bigger business are less risky than smaller business. For example, banks and other financial institutions charge lower rate of interests on loans or overdrafts to businesses they consider safe. 4. Marketing. Bigger business can direct more effective marketing campaigns. Only large business can afford sponsoring of major sporting events such as Olympic Games, the Super Bowl or the Football World Cup, which are especially higher yielding promotions per dollar, pound or euro. 5. Purchasing. Big business can gain discounts by bulk buying, which buying in large quantities. Supermarkets such as Walmart and Tesco buy large quantities of food at very low prices from farmers. 6. Risk-bearing. Big business can afford to produce a bigger product range and in doing so spread the risk of one product failing, hedging their bets. Pepsi Corporation owns a number of different branches such as Pepsi, Gatorade, Tropicana, Lipton's Tea, Quaker Oats, and Lay's. Table 1.6.2 shows external economies of scale, Efficiencies that the business achieves because someone else has expanded. 1. Consumers. A shopping mall increase a number potential of customers as more people go to the mall compared to an independent shop because of ease of one-stop shopping. So, a whole range of other businesses benefits from someone else building the infrastructure. For example, a shopping mall, an international airport, and a business park or zone all requires servicing and maintenance as well as their core business. 2. Employees. Labor concentrations. Some cities and geographic areas concentrate on certain industries or sectors. Individual businesses located in those areas and operating in the industry that has the concentration can often benefit from lower recruiting and training costs. Hollywood is famous for having many actors and others skilled in various aspects of films and television production. London is major in banking center, where numerous professionals in financial services live and work. Table 1. Internal diseconomies of scale, inefficiencies that the business itself can make. 1. Technical. Example: a container ship can be too big to berth in a harbor, an airplane too big to land at smaller airport, or lorry too large to drive on minor roads. 2. Managerial. Business may have over-specialized managers who cannot or will not work outside their area of expertise or for everyone's benefit, which often occurs in the investment and commercial banking sectors. 3. Financial. Sometimes, big businesses with large amounts of surplus cash make poor investments. Poor decisions occur because the business do not think through the consequences of investment choices. 4. Marketing. Sometimes big businesses can make big marketing mistakes. 5. Purchasing. Large business often buy too much stock, which can be costly if the capital funds used to purchase the stock are greater than the cost savings from buying in large quantities. Stock can also become spoiled, obsolete or unfashionable. 6. Risk-bearing. In 2005 eBay bought Skype in the hope of broadening its range, but in 2011 sold it to Microsoft. Table 2 shows the external diseconomies of scale, inefficiencies that the business achieves because someone else has expanded. Employees. If one geographic region becomes too concentrated on one economic activity, typically a shortage of skilled workers in the industry will occur. For an individual business, this relative shortage of skilled workers means that the business will have to pay higher wages than before to attract and retain skilled workers. Growth and evolution. The merits of small versus large organization. Many firms want to be in small firms to avoid the headache and complexities of large firms. Many businesses offering high-end products and service. Businesses prefer to stay close to their markets and their clients. There are innumerable small firms and big firms around the world. Advantages of being a big business. 1. Survival. It enjoys economies of scale, greater profits, higher return. 2. Higher status. Large firms have greater status than smaller ones. 3. Market leader status. McDonald's is the market leader in fast food restaurants. 4. Increased market share. Large share in market, determining prices, setting up the industry standards. Advantages of being a small business. 1. Greater focus. 2. Greater cachet. 3. Greater motivation. 4. Competitive advantage. 5. Less competition. Practice assignments, exam prep assignments for the IB Business Studies syllabus. You may now proceed to try out the exam preparation assignments. All assignments will be marked and feedback will be given. Should you need to speak to one of our tutors, send your email to administration@intmace.com. Please proceed to the link www.economies.com at the bottom of this video to commence with your practice.